Hi, everybody. Welcome to another one of COL's Quick Takes. I'll be your host today. My name is Juanis Barredo. I am Chief Technical Analyst for COL Financial Group Incorporated, and today we're going to talk about understanding bottoms. Now, the reason why we're looking into discussing this particular topic is really because we've seen our markets come down for quite some time right now. And many times we're always put into a situation where we ask ourselves, this decline that we've seen has been leading to a bottom or not. And today we're going to try to figure out what we need to know so that we can best make a much more, decision that is more clear rather than trying to be able to make guessworks happen. So predicting bottoms, can be quite a profitable trade if you do it correctly. But unfortunately, trying to pick a bottom of a market is not exactly a very easy process. And many times traders usually guess to try to see whether a bottom will hold or not. And many times when you guess, yes, you can be wrong. And you'll probably guess and maybe be wrong once, twice, or even three times before actually getting it right. And that could be quite costly for making these types of trades. So the whole idea now, it can help a little bit more if we know a little bit more about what bottoms usually draw themselves out to be before you start trading. That way we can manage our expectations and we can control the way we attempt to be able to trade these things. Now, when we talk about looking for a bottom, let's try to understand exactly what a bottom is first. It is the ability for a market to show a very firm base. That's why they call it a bottom. And it's so strong that it allows itself to reverse a downtrend and eventually turn prices back up again. The problem is that every time that the market comes down and makes a typical or maybe small rebound, we all ask ourselves that question now, is this the bottom? And as prices, as you see in a down slant like this, every time a little recovery comes in, our market plays with us and we ask the question, could this be it? Is this the low? Should I enter now? And then here we are, we try buying, market starts to fall back down, breaks into a new low, and then now into the next low, we ask, could this be the next bottom? And we continue to do that as prices continue to be able to deteriorate. And the reason is because we don't know for sure whether a base that we are seeing is very temporary or whether this is the lasting and the major low that everybody's waiting for. Now, the kind of low that we want to be able to look for in a market looks something like this. It takes a gradual point for prices to come down, and I'll explain the reasons why that is in a little while. But what we want to see is we want the market to tell us that it doesn't seem to want to be going down anymore. So if you see this area where you see prices start to flatten off and retest its low several times, telling you that, okay, I've tested this low and it didn't want to break, tested this low, it didn't want to break, and do the same here. It kind of tells you that the market has found its footing, and the footing is quite strong, and so strong enough that it's managed to turn prices back up into an uptrending situation. And this confirms that we did indeed find a bottom. Now, how do we come around to be able to put some degree of rules in understanding what this would look like? So if we were to look at the first part again, we got to get rid of the guesswork out, because guessing is not going to be adding any profits to us. So first thing I would advise you to do is to be able to look for this basic ingredient into a downtrend. In a downtrending market, we will always see this kind of a decline, and you will see these attribute into the particular trend. You will see lower highs followed by lower lows. And as long as the price continues to move in that direction, please stop guessing whether this is the low, this is the low, or this is the low. Just allow prices to fall down until one day these attributes change, where you don't see lower highs anymore and you don't see lower lows. That would be probably the soonest that you can even detect that the market is trying to base. So let's go back into that second example we showed earlier. So we're going to use two particular tools to try to make this happen. So first, let's check lower highs and lower lows. We have the same condition coming out in this area right here. But on this stage where you see I turned the color into a green swing, range activity, you notice that the lows are no longer falling down to showing lower lows or lower lows later on. This is the first tip that the possible major low could be drawing itself out. So second, do we see lower highs? And if you see in this particular case here, the highs are pretty much the same as what they did in the previous one. So what we have is we have now a downward moving market going into a sideways moving market. It's not upwards yet until what you see here. But while this is now moving sideways, that would be your first clue that the potential trend turning could very much detect that the bottom is being framed. If one day this continues to break down and fall and make a new low, then that is not yet the bottom, and that was just a temporary pause into the decline, and we would have to adjust things later on. What we want to see is that the ingredient from lower highs and lower lows to change into higher highs. So you can see this high here, followed by a higher high and higher high here, and the low from here becoming a higher low and higher low. When you see higher lows and higher highs work in like the way in opposite of what you have up here, then that means from a downtrend, you've now switched back into an uptrend, and this now confirms a major bottom being shown. And that's how you know that the market has had enough and now can continue to do something a bit more heftier into the recovery phase. Another thing you can do is to be able to wait for downtrend lines to break. So for example, I drew a downtrend line here, broken over here. That can also give you a tip of the potential turn in trend could happen. But you can see that after the sideways range, we waited for a breakout condition before acknowledging that a bottom indeed had already taken place. So these are just two added confirmation tools that you can use to be able to put ourselves in as a check mark that the market has managed to be able to establish a major bottom. Now, let's try to understand more about two types of base information. How do markets bottom? Well, we normally have two types of bottoms that the markets will form. The first one is what I would call a slow or gradual bottom. Now, when we say slow and gradual, that means you could see a deterioration over in time and perhaps just go up and down in a sideways fashion for also a lengthy period of time. And the reason for that are quite clear. So number one, you will see a very much a long and lengthy decline. I will show you what the image looks like in a while. And this will be followed by a gradual basing swing. So for example, if you're seeing a relatively hefty decline, you will see it eventually turn itself more gradually over. Now, the reason that's happening is really because the sellers right now are not liquidating everything in a very, very quick pace. They're trying to make an assessment of the economic situation or the corporate situation. And because of that, you probably see a lot of volatility along that decline or that bottoming period. So you will get volatility inside there, but it will be not as wide. They tend to be more controlled or, let's say, pressed into a smaller range as time moves on. Also, the reason behind the slow and gradual bottom is because there are a lot of fundamental reasons that are very much negative that's keeping prices into that deterioration. For example, we're worried today about a potential recession, a potential that earnings from companies may decide to slow down. And it's because of those issues that it could contain or make it a bit more longer in time for this recovery to be able to come out. And so that is something that you have to be able to try to build in as well. Also, there are a lot of headwinds taking place. When we say headwinds, we're talking about things that are going against you. That's why it's calling a headwind. So for example, the bad news we're hearing currently into the markets, whether it be rates or inflation. Right? I'll talk a little bit about that in a while. And these things don't just disappear overnight. It takes time for these things to resolve these problems. And because it takes time to resolve these problems, it might also take time for investors to be convinced that the worst is over and that they might say, okay, let me see what happens over in time and see if the risk levels decide to be able to contain themselves. And then maybe I should start looking to buy into this market and cause a reversal. So since the sellers will take time to be able to finish and the buyers will also take time to go in aggressive mode to buy, then that's why you have a very slow and gradual bottoming out process. Now, there is another type of bottoming out process that could be very, very fast. And we call this a capitulating bottom. The word capitulate means to be able to heighten that you get a very sharp decline, usually with heavy emotion. So it's very fast paced. And normally it comes after the market has been coming down for a while already. And so what happens is that the investors get so frustrated with what they see. And they decide, okay, I don't want anymore. I want to stop this bleeding. I don't want to stop this pain. So they liquidate everything that they have. So when everybody starts to feel the same way, you have a massive amount of selling taking place. You see prices engulfed in a very, very sharp decline. Now, this could be triggered sometimes by frustration. It could also be triggered because you've just had some fresh negative news that have come out after maybe a series of negative news already, and that driving the investor out of the market with much more heftier moves. So the move becomes very sharp, and the reason for that is because it becomes very emotional. And the seller just wants to be able to sell as fast as they can because they don't know what will happen because of the conditions that I've just managed to be able to make mention of. But it becomes so shocking to them that they want to react very, very quickly. Now, the nice thing about a capitulating bottom is that it happens very sharply and quickly. It drops very, very quickly. And then after that, no more sellers, right? And what happens is you have a major market rebound that comes in, something that we would call a V-shaped type of recovery. And that's because the sellers have emptied their hands. There's nobody left to sell any major things. The immediate base is determined and a rally comes off something like that. So to be able to show you an example of each, this is an example of a slow and gradual bottom. So you have, for example, here, this was BDO sometime between 2020 and 2021. It fell relatively sharply. You could even call this a capitulating move, but it did not rally all the way back up. So did this not make any type of V shape? In fact, if you look at it over the lengthy period of time, it generates something more of rectangular recovery, maybe eventually into a triangle, but or a square root type. Square root is because you fall down, up, and then it goes sideways, right? And maybe you could even classify this as a slow W bottom because it moved up, down, retest again, then recovery two or three times, and then make a recovery. But the essence of this is you will see a lot of volatility towards the base of the market. And it's very unlike what you would see in a capitulating or a very fast bottom that would look something like this. So this happened sometime in Ayala Core in 2020. This is roughly during the period when we saw the pandemic begin to impose some lockdowns. The Ayala Core and other different markets just fell down so rapidly, but then a major recovery came in, like a V-shaped type of recovery. See the letter V that you have here. And the rebound was really very, very quick and sharp. And so as fast as you saw the major decline just come in, it was finished. Sellers sold what they did, and then next thing you know, you have a major recovery in hand. So what was the difference? So the difference in this particular situation is that in the case of Ayala Core, it reacted to the announcement that we were going on lockdown. So it had to impute that into the price right away. And so it fell down. But perhaps it fell down so much so that this selling massacre, if you would, just went out of proportion. And as people said, okay, so this is it. This is the worst thing that we could even hear of. Anything that comes off this should be a little bit better. And it's the reason why eventually Ayala Core just rallied relatively sharply. So if the nature of the problem tends to be very much lasting, then normally you will get a prolonged type of basing pattern. If the situation means, okay, you're seeing the hardest part right now, but it will be getting better already from here, then there's a chance that you probably see a very sharp or capitulating bottom in expectation. So I guess the question you're going to ask right now is, why do we need to know that one bottom from the other? Well, the whole reason behind that is really because I need you to understand that your mind has been prepared for what is about to happen. Because you're going to be trading this market. And if you don't know what to expect, then anything you do will be a guess. It's very hard to make good and lasting and consistent money by guessing. And so we have to be able to improve your ability to anticipate what may happen. That way I can prepare for it. Because if you manage to do that, then it's easier for you to control what you're doing in your trade. So if your expectation, for example, is because you see a lot of headwinds taking place, that a longer bottoming process may come out, then that should tame your ability to become too aggressive in the market. So don't just be buying left, right, and center because, wow, beautiful discount, let's just buy and close my eyes. No, right? It could take some time. It could stay low. It could go lower. And that's a reason that you have to really very much consider, are the headwinds still pressing on? And if the answer to the question is yes, and if you feel that it might take some time to unwind, then take your time. Don't be too aggressive. Only do that perhaps when you see mini capitulations, then perhaps you can go ahead and try to buy your market, but space it out in time. Now, if you're anticipating, for example, a V shape. So for example, let's say you came around into a company that talked about a particular negative piece of news. Let's say because of a supply problem that they couldn't produce a particular thing, but they'll solve the problem 2 or 3 months from now. Well, you'll probably see a very sharp decline first because that will impact on the company's bottom line, but it will not be too lasting. So your mind should be prepared to be able to take advantage of this V-shaped bottom that may come out. You will see a very sharp decline. Take your course. You can now be a little bit more aggressive in that because you know it will not be too long lasting. And after you see the capitulation, you will see the rebound start to begin. And that's when you can start to be able to buy your position a little bit more aggressively and perhaps with a greater degree of confidence that you might be able to make more immediate profits in your trade action. So the reason we have to be able to set our mind straight on knowing what to anticipate or expect from a market is really because we want our minds to be prepared, right? The more prepared we are for what is to happen, then we know that we can control our hand much better. If we see market will recover faster, then we can be more aggressive now. If this looks like it's going to take some time, then we should take our time to be able to buy things, and only when we see the value or only see the right timing essence of what these things are about. So now we want to be able to answer that question I've been getting hit by a lot of is, what type of bottom do we expect our market to do today? Right? We've been coming down already for quite some time. We've been hearing a lot of problems come inside. And so what? I mean, does this still look like we're going to linger here, or are we now looking for a potentially fast bottom? Well, first thing I will do is review the headwinds. And if I were to write them down, as many as what I've showed here, for example, we're dealing with high inflation. That has not ended yet. We are seeing interest rates going up in an attempt to try to fight inflation. This is still happening across the world. We have a weaker currency, and that's also because of the stronger dollar and the ability for us to be able to handle the inflationary situations per country that we're currently in. We have a war in Ukraine to continue to worry about that are causing some problems in supplies of food across the world and causing elevated oil prices. But fortunately, that's come down a little bit, but not as much as we would want to. And we also have this zero COVID policy in China, which is slowing China's growth and preventing them from being a much bigger contributor to global growth. And so these particular facets that we're currently dealing with have not finished themselves yet. Their impact is still being felt today. But hopefully there is a little bit of talk that much of this has been imputed into the movements of price already, but we are not finished. Some of this could still take some or a few months to be able to deal with. And as such, I can't tell you that this is going to be solved in the next 1 or 2 months. Given that, since these are not going to be solved right away, my expectation is that a gradual bottoming out process is what we are anticipating here. And being so, we have to be able to align ourselves in our action accordingly. So how do we handle this type of bottoming out process into our market? So it's very important for us to understand that we have to act with patience and careful discretion. Now, when I say patience, I know some of you, perhaps, if you still have some cash available, do want to take advantage of the discounts we've seen into the market today. But remember, we do have headwinds to deal with. And if you're going to be buying, I would suggest that you wait for moments where prices come falling back to support or come down first before they rebound, right? The last thing I want you to do is to be able to buy your favorite stocks after prices have already rebounded, let's say 5 or 10%. back off from that. Remember, this market cannot run away from you because there's still a lot of problems to fix. So what you wait for the markets to pull back again. When the market pulls back and it starts to quiet down and roundabout, and that's the time that you can go ahead and gradually buy your positions over in time. Okay, so go ahead and zero out on what plans you're going to make, on what stocks you're going to buy, but it might take some up and down movements or push and pulls before you can see more solid bases flesh out through some of this. So if you're going to buy and you want to buy on the discounts, go ahead, but space it out over in time. Stretch your buying over that period. Okay, I would assess that perhaps earnings perhaps might start seeing the maximum drawdown could be maybe on the second quarter or even the third quarter of next year. So you might want to be able to wait off to maybe a quarter before that period, because in my belief, the market will bottom out before the fundamentals tell you it's starting to get better already. Markets will always move ahead than reality. So normally, if you expect things to start to improve already, maybe you should be acting one quarter before that. Now, what type of patterns do we come around to anticipate? Because we say this is going to be a gradual bottoming out market. We can look for rectangles. They look something similar to these. Rounding bottoms would look something similar to these. Takes time to make like a U-shaped recovery. Square roots would be first a big decline like this, a temporary recovery, then a gradual consolidation, and then eventually it will break out of that and turn, right? That's what we call like a square root type of pattern. And then we also like the W-like bottoms that could take a little time to build. So for example, similar to this, it will also fall down sharp. Recovery could be semi-sharp, might even look a little bit like a V-shape, but then you will see prices will go all the way back down, if not close to the previous low it made. And this is the W-like formation, and then reverse and eventually make a much stronger rally. So these are the kinds of patterns that we're probably going to see looking down into the next few months. And we would rather that you be prepared for this, because if you were to be buying this, like I said, you don't want to be buying when prices are rallying and now on, let's say, on this side of the recovery, you want prices to wait and come back closer to the low. Same thing here in a U-type pattern, maybe just accumulate gradually over time as prices in the low, and eventually you'll probably feel the effects of that when prices start to recover a bit more aggressively. If it will square root, again, don't just buy in the initial rally. Wait for prices to zigzag back down gradually. And on the low ends of these ranges is where you can pick up your positions. Or if we do see a W, again, don't be buying too much on the high end of the recovery. Wait for prices to retest support. And on a successful retest and you see prices rebound, this stage over here is the perfect time for you guys to be able to be a bit more aggressive in buying your positions back. So I hope that I've managed to be able to give you more insight into what a bottoming market would look like. And again, understand that preparing your mind is very important, because it changes our ability to be a survivor into this bearish drift that we have, so that we can put our money in when it counts, and we can be more understanding of how the markets will eventually change, and how us moving from a very defensive situation can come back into a market in a better time to become more aggressive and take advantage of the much wider rally that will come in due time. So with that, I bid you good luck, and thank you for taking up our quick takes once again, and I hope to be able to see you into our next episode. Goodbye, everybody.